Hello, my name is Michael Barrow, the MB Secure Financial Employee Benefits Specialist. And today I'm speaking with Jean-Pierre Laporte, who's CEO of INTEGRIS Pension Management Corporation. And today we're going to speak about personal pension plans, or the PPP. So JP, before we dive into some questions, can you please tell us a little bit about yourself and a little bit of background?
Sure, yeah, my pleasure. So I'm a pension lawyer by background. I spent a decade on Bay Street in Toronto working in large private sector firms, law firms, specializing in the area of pensions and benefits law. And I quickly realized that unfortunately, a lot of people in the small private sector, the same sector that you're operating in, Michael, do not have any real pensions for the owners and the executives of the companies. And so they're stuck with RRSPs or tax-free savings account or maybe a defined profit sharing plan, but they don't have true gold-plated pension plans the way that civil servants, teachers, and other people have. So that was the impetus for getting into this PPP business.
Yeah, that's fair enough. Okay, so I know what a PPP is, but can you share with our viewers today why it is better than other types of registered solutions?
Sure. Well, the PPP is a combination registered pension plan. So what it does is it combines everything that's great under the Income Tax Act in terms of tax sheltering. We have three components, three accounts underneath a single PPP umbrella. And the three accounts are, the first one is called the defined benefit component. So if you're familiar with IPPs or individual pension plans, everything that those plans have, we have. We just call it something different. And I won't get into all the tax advantages of those. On top of having the defined benefit rules, we also have a defined contribution account and a third account called the additional voluntary contribution account, or AVC. And that allows you to transfer RRSPs into the pension plan to trigger a whole bunch of additional tax advantages. So that's why the PPP is the most tax-effective retirement solution permitted under the Income Tax Act, is because we engineered it that way, to put together and pool together all of the rules under one single solution.
Okay, so you mentioned taxes there, and we know business owners are always seeking ways to save on taxes. So can you please tell me about some of the tax deductions available with the PPP that don't exist with the RRSPs or even some of the defined contribution pension plans?
For sure, yeah. Well, there are tons and tons, so we don't have that much time. I'm just going to hit the highlights.
Sure.
First of all, and I'm going to try to do this in a sequential way, so from the very beginning to the end over time. So when you sign up for the plan, we have the ability to do what's called a buyback of past service. So if, as a business owner, you've been collecting, or as an executive, you've been collecting a salary from your employer for a number of years, we can go backwards and recognize the past service. All those years that you weren't contributing to a pension plan, we can now create a deduction for those years. Then, in the year of plan setup, we're also allowed to do an RRSP contribution. Why? Because the RRSP contribution this year in 2021 is based on 2020 earned income, whereas the PPP annual contribution for 2021 is based on 2021 salaries. So you see, in the current year, both systems overlap, which is why we're allowed to do a double contribution, double deduction, double tax refunds. Then, in the first year, and in subsequent years, we're allowed to exceed the RRSP maximum amount. So there's a gap. There's even more contributions that go in every year. And the reason for that is because we're using either the defined contribution or the defined benefit rules, and those are more generous than the RRSP rules. In addition to that, all of the investment management fees, which unfortunately in an RRSP, you're not allowed to write off, those same fees now become brand new tax deductions for the business because we're dealing with a pension plan. And under pension law, you're allowed to write off those fees. Now let's move forward a little bit in time. After the first year or the second year, putting more and more money, but there's another tax deduction called special payments. Now, special payments occur when the internal rate of return on your invested assets is below 7.5%. So if you're, let's say you're really risk averse and you don't like to be exposed to the gyration of the stock market, and you say, you know what, Michael, put me in bonds, government bonds. I don't want to lose any money. Okay, so the bond's going to pay what? 2%, 3%, whatever, some low rate of return. That's going to be less than the 7.5% target. So that gives us the ability to ask the corporation to make these special payments with pre-tax dollars to create even more tax write-offs. So that's the special payment. Now, in subsequent years, remember I told you in the first year you can put money in an RRSP. In subsequent years, you can also do another small contribution called a pension adjustment offset amount. And that's $600 extra of tax room that you can put in every year. Now, let's say the company borrows money in order to contribute to the plan. The interest is also tax deductible. Okay, now you're approaching retirement and you say, JP, I don't want to work till 65. I'm going to switch from collecting a salary to collecting a pension from the pension plan at, I don't know, 60 or 50, 52, doesn't matter. Any age can be used. Okay, so the problem with that is that if you start collecting much sooner than expected, we can't afford to pay you the full pension that you would have had you start at age 65. So let's say at age 65, you're entitled to $100,000 a year pension. Well, if you're going to start at 55, you'll be lucky if you get $30,000 a year. It's a massive reduction in your standard of living. However, this is where the PPP comes in. We can increase the early retirement pension by layering on additional supplemental temporary pensions to the basic pension. The $30,000, we can throw in another, let's say, $20,000. So now you're starting at $50,000 at age 55 instead of 30. Well, how can we afford to give you all this extra money every year? It has to come from somewhere. Where does it come from? It comes from the sponsor of the pension plan, which is your own company. So this terminal funding payment is fully tax deductible to the company and doesn't create any tax consequences to you, even though technically it's an employer benefit. So I'll stop here. There are more tax advantages, but I don't want to lose your audience.
No, fair enough. Appreciate that. That's good. Okay, so when it comes to pension programs, they have fees. So what about the fees themselves? You did kind of touch on it briefly there, but what about the fees to keep the plan going? Can you describe that a little bit for us?
Yeah. Now, two things about the fees. There's the posted fee and there's the real fee. The posted fee, if you're using an insurance company as the custodian for the plan, is about $17.75. If you're using a trust platform for the PPP, then it's $2,800 a year. So that's the posted fee. Mm-hmm. The true economic fee, once you factor in all the tax deductions and the tax refunds that I've been kind of hinting at, talking about with all the special tax deduction, is actually negative. It's zero. It's not. It's less than zero. It actually generates tax refunds, right? Okay. So in reality, the PPP auto finances itself and actually makes you money from day one. But the posted fee is depending on the platform, whatever it is, right?
Right. Okay. Very good. Now, I have a question specifically about family businesses. A lot of clients I have family members that own the business and actually work in the business itself. So and they're on the payroll, obviously. Can they also participate in the PPP?
Well, yes, and I'm glad that you asked that, because there's a feature of the PPP that is so important and not well known in Canada. And it's what I call intergenerational wealth transfers. So let's use the example you just gave me, Michael, of family business. Mom and dad and the two kids are all on the payroll, right? They all work in the family business. Mm-hmm. So you're going to set up a PPP for the family. And all four will be participating. Now, mom and dad, I don't know, they decide to retire early. Maybe they do this terminal funding that I was talking about. And they take $1 million from the corporation, claim a tax deduction for that, dump it into the pension plan to give it enough money to pay them a higher early retirement pension. So they're on pension. They're no longer taking a salary anymore.
Mm-hmm.
Disaster strikes. The next day, they both die in a car accident. Had this been an RRSP or a RIF, we would have what's called a deemed disposition, right? The Income Tax Act deems, I know you know that, Michael, but just for your audience, the Income Tax Act deems that you've disposed of all of the assets in the plan at fair market value the day before you died, and it's the terminal return that your estate trustee has to file with CRA has to recognize this income and pay tax on it. So typically, over 50% of the RRSP or RIF account has to be paid in taxes. But we're not in an RRSP RIF, we're in a PPP. And we had the foresight to put the children inside the plan. So now what happens? Same situation. Mom and dad pass away the next day. Nothing happens. None of it gets taxed. The whole thing becomes surplus. And now, because the children are also plan members, they have the right to use that surplus to fund their own pension entitlements, or to just leave it there and let it grow, or to pull money out as they need money for expenses. Now, of course, if they pull money out, they're going to have to pay tax on what they pull out. But so long as they don't need to pull anything out, those millions of dollars will just keep growing tax sheltered until such day as they need to retire or they want to pull money out. So the basic equation is, I can either give half or over half to the CRA on death, or give it to my children instead. That's the basic choice that people are facing. RRSP or PPP.
Very good. Well, based on the information you shared with us today, I mean, I have to ask, is the PPP on side with the CRA in the form of, is the CRA okay with this? Because I mean, all the advantages make it seem too good to be true.
Yeah, that's what we've been, that's the comment we've been getting for the last 9 years, is people have been saying it's too good to be true. Government's going to have to shut you down. So we're still waiting. In fact, I'm not too worried, because when INTEGRIS first proposed the PPP to the industry, we went to the Canada Revenue Agency and we submitted our plan text to the Director of Registration and the Director of Policy at the CRA in the Registered Plans Directorate. Those are the people that administer all the pension plans and the RSPs and all that good stuff. They took 6 months to review every clause, every word, every comma of our plan text. And then they came back and said, wow, very impressive. We don't have any problem with this. This is completely above board. Good for you. So at the time, I asked CRA, can we have this plan text automated through what's called a specimen system, so that every time we send a new application, it automatically gets the stamp of approval, doesn't have to be reviewed by CRA staff. And at the time, they said, unfortunately, we don't have the ability to give you a specimen because of the combination structure of your plan. So we'll have to scrutinize every plan application you send us as if we had never seen the last one, right? It's a de novo analysis. And I said, well, you know, it's a lot of work for you guys. And they said, yeah, but that's the way it works, and we're just going to have to do the work. So I said, okay. 2 years later, I get a letter and a phone call from CRA saying, we've changed our policy. We now would like you to consider submitting your plan text as a specimen so that we can automatically approve it every time you send it in. So if CRA and the government had an issue with the PPP, I doubt that he would have picked up the phone and called me and asked me to automate it.
No, for sure. Excellent. Yeah. Well, excellent, JP. Well, thank you very much for sharing everything. In closing, is there anything else you want to add about the PPP that people should know that we haven't touched on today?
Well, there's all kinds of other features that people often don't know about. Look, the fact that pension assets are creditor protected. There's a certain level of extra protection in bankruptcy. There's some additional facility when you want to invest cross-border. There's the ability also to, if you become a non-resident, the millions of dollars that you were able to put in your PPP are exempted from another tax rule called the departure tax, or the deemed disposition on becoming a non-resident. So that's another massive tax headache that our clients can avoid by having a lot of money in their PPPs. So I could keep your folks on for many hours, but I won't. I'll stop here and say,
Right.
you really should take the time to learn about this. If what you're trying to do is pay less taxes and end up with more money in retirement.
I think that's a goal for everybody, and I appreciate that, JP. So thank you much for your time today, and I look forward to meeting with you and potential clients going forward.
Thank you.
Thank you.